Hi, this is Dan Smith of DPS Legal Counsel, and welcome to today's video and podcast episode of Legal Scrubs. Today I want to talk about an issue that often comes up when a physician or a dentist or some other health provider is just getting started on starting his or her practice, and that is the choice of entity for the practice. Should it be a corporation, or should it be an LLC, or even something else? This issue also can be addressed by a healthcare provider who's already in a practice but has some questions about whether or not it makes sense to revisit the form of entity that that healthcare provider is using for his or her practice. So let's just kind of talk about today one option that you have when you're looking at either forming or looking at the choice of entity you already have for your healthcare practice. And that one option I want to talk about today is an LLC that has elected or does elect to be taxed and treated as an S corporation. Now that sounds a little complicated, but it really isn't. Setting up an LLC is typically what most businesses, including health professionals, do these days. LLCs, or limited liability companies, are easy to set up. They're flexible in how their terms are set out. They give you a lot of ability to do what you want within your practice, within your entity, and there's really less formality than you typically have with a corporation. And so LLCs have sort of become the entity of choice for most businesses these days. But one of the things that you run into with an LLC, if you're either the sole member of the LLC or you have several members of the LLC, let's say you have a medical practice and you're the only doctor there, you're the owner of the LLC, or maybe there are 2 or 3 doctors in your practice and you each own the LLC. What you run into with an LLC is that under tax law, you cannot be an employee of an LLC that you own. You're treated as self-employed. And so because of that, the funds that, the compensation you get from your practice, from your LLC, is treated as self-employment income. And because it's treated as self-employment income, whether you're in a solo practice or you're in a practice with several other doctors or dentists or whatever, you're going to pay the self-employment income tax on your compensation. So for example, if you are a sole practitioner, you're a doctor with an LLC, you're treated as self-employed. Let's say that you have income that passes through to you from your practice of $200,000. Well, you're going to have to pay not only the employee share, but the employer share of the payroll tax, the Medicare and the Social Security tax on that full amount that passes through to you, because you're not, you're treated as self-employed, so you have to pay the full freight on the payroll tax, which is 15.3%. So just doing very round numbers, if you have $200,000 of compensation that flows through to you as self-employment income, and you pay a 15.3% payroll tax, you're going to pay $30,600 essentially in payroll tax, just for the benefit of being a LLC, a self-employed owner of an LLC. On the other hand, you could consider electing S corporation status for your LLC. Now, what is an S corporation? An S corporation is essentially a corporation that has elected to be treated as a small business corporation under Chapter S, Subchapter S of the Internal Revenue Code. And so S corporations traditionally have been treated like LLCs. They're pass-through. They don't. The corporation is not taxed at the corporate level, but the funds that are newer to the corporation flow through to the shareholders, to the owners, and then they're taxed to the shareholders. So in essence, S corporations were sort of the original LLC. They were a pass-through entity that was a corporate form, but allowed the shareholders or the owners of the business to be taxed directly rather than having the entity taxed. So why would an LLC elect to be treated as another pass-through entity, an S corporation? Well, the reason is this. Although you cannot be an employee of your LLC that you own, you're treated as being a self-employed person, and your income is self-employment income. With an S corporation, you can be treated as an employee of the S corporation, and because of that, you're not a self-employed person, and so you only have to pay the payroll tax in connection with the income that you as an employee receive. And so you can save on Social Security and Medicare taxes on that share of your payroll tax by electing S corporation status and only paying the payroll taxes on the amount of your income. And so let's say, for example, you had the same kind of practice that we talked about before, and there's $200,000 that can flow through to the owner of the practice. If you're an LLC, all of it's going to be taxed at the 15.3% level because you're self-employed. But if you set up elect S status, you can pay yourself a reasonable compensation as an employee, but not all the money that flows into the business or to the practice. And so in the example where $200,000 flows in, maybe you only pay yourself as salary $145,000 rather than the full $200,000. And the other $55,000 that you don't pay to yourself as salary can come back to you as a dividend. And the amount that comes to you as a dividend is not treated as compensation for services. It's not treated as salary. And so there's not a payroll tax, that 15.3% payroll tax imposed on that $55,000, which is treated as a dividend. Now, so you can see there's a savings on payroll taxes if you elect S status for your LLC. Now, there is a caveat. You have to pay yourself a reasonable compensation as the owner of an S corporation or an LLC that elects to be treated as an S corporation. So you can't pay yourself zero and say all of it's a dividend. You can't pay yourself even a small amount and say all of the rest of it is a dividend. You have to pay yourself a reasonable compensation. Otherwise, the Internal Revenue Service is going to come knocking at your door. So what is a reasonable compensation? Well, that's something that can be looked at on a case-by-case basis depending on what type of practice you have, what's common in the industry, all kinds of facts and circumstances that you can take into account. One thing that is sometimes suggested is if you have enough money coming in, let's say you have $200,000 coming into your practice that you can either divide between salary and dividend. If you pay yourself at the cap amount for wages for the Social Security tax, which is currently in 2021 is $142,800, then the IRS can't say that they haven't got the full amount of the self-employment tax for the Social Security portion of your payroll tax, because you've paid the full amount that you would be taxed on anyway. You'd be saving essentially on the Medicare portion of the payroll tax by not paying the full amount out. And so that's another thing that you can keep in mind when you're talking to your attorney or to your CPA or whoever advises you on your practice about setting up what would be a reasonable compensation for your practice. If you pay yourself at the wage cap, if that's the salary amount that you've determined is reasonable, then the IRS cannot say that you're not paying the full amount that you would otherwise have paid on the Social Security portion of the tax. And if that amount, which is equals to the wage cap, is otherwise a reasonable compensation in your industry, in your type of practice, then that might be something you could consider. Again, you have to look at your own particular facts, your own particular circumstances. Talk to your own tax advisor about that. But that's at least a possibility. So, in recap, in summary, in conclusion, one thing that a new practice can consider in starting out in choice of entity, or an existing practice can look at if it wants to look into the possibility of perhaps saving taxes, is having, rather than a straight LLC own your practice, be the form of entity for your practice, having an LLC that elects S corporation status, and then paying yourself a reasonable compensation as salary, and thereby being able, under the circumstances that you might have, to save on the payment of payroll taxes with respect to the money that you make. I hope that helps. It's an interesting area, and one that probably merits exploring, either when you're starting out your practice, or maybe if you're doing a little after the fact look at your practice to see if there are ways that you can improve your business operations and maybe save yourself some tax dollars. All right, that's it for today. I hope that helps. We'll talk to you next time.